Alex, and this is my price action trading course. The current module is about channels. The market is in a channel whenever you can draw two lines that contain the bars on the chart. And any pair of lines that contains a section of the chart is a channel. The lines can be parallel, they can be convergent, and they can be divergent. The channels can rise like in a bull channel, a bull trend, and the channels can fall like in a bear channel, which is a type of bear trend. A channel is a weak trend. It's a trend, but it's weak. It's not as strong as a breakout. Trends can either be breakouts, very strong, very vertical, or they can be channels. And a channel is a weak bull trend. It can still be very steep and strong, not as strong as a breakout. There's a bull trend line below and a bull trend channel line above. And a bear channel can also be very steep and down, almost as strong as a breakout, but it's still a form of weak bear trend, weak compared to a breakout phase, a spike phase of a bear trend. There's a bear trend line above and a bear trend channel line below. You only need to see one of the two lines to know that the market is in a channel. As soon as you see either a trend line or a trend channel line, the market's in a channel. Even if the channel doesn't look right, even if it doesn't look conventional, there's always an opposite line, even if you don't see it. As soon as you see one line on the chart, assume that there's a channel and that there's a line that you could draw. Here you could draw it above here. Ultimately you could draw it above here. So even if the second line is not evident at the time you see the first line, the market is in a channel. Here you can see a trend channel line, so the market might be in a channel, and then you look on top and you think, well, where does the second line go? Does it go down here? Does it go across here? If it goes across here, it looks like it's divergent and too broad. That doesn't look right. Well, the market's always in a channel, so you always have to look at any possible line and accept that it may end up working as the other side of the channel. Okay, so this is the only obvious choice for the top of the channel. The lines are not quite parallel. This line has a flatter slope, so they're somewhat divergent, but it's better to assume that this will contain the price action and that this is a channel until proven otherwise. And here you can see that the market came up and hit that line, and now it looks like this line is a possible top of the channel. After every failed breakout of either line, the top or the bottom of the channel, once the market reverses into the channel, you redraw the line using the extreme point of the breakout that went beyond the channel. Channels tend to get flatter, more horizontal. They tend to get broader. The lines tend to get further apart. And eventually the channel evolves into a trading range. So here's that initial bull channel. The market broke out to the top. As soon as it reverses down, you draw another line. The market here went above that first line. It reversed down, so now you draw another line. And here, I didn't extend this line forward, but we broke above it, so now you look to draw another line. And you can see these lines are becoming increasingly flat. The channel is losing momentum, it's becoming flatter, and eventually it will evolve into a trading range. When the market gets to the top or bottom of a channel, it offers traders trading opportunities. The market can break out and enter a breakout phase, a strong trend phase, or it can reverse. In either case, you can find trades where the reward is much bigger than the risk. So you tend to have excellent traders' equations near the top and bottom of the channel. The easiest thing to do is look for a reversal and enter on the reversal, and then expect the market to test the opposite side of the channel. Remember, the market's in a never-ending cycle. It's in a trend, either a breakout phase or a channel phase, and then it enters a trading range, and then from the trading range it breaks out again in either direction. So then you are back to the trend phase. As part of the market cycle, you have the breakout and then the channel, and the channels usually evolve and become parts of a trading range. A channel is a hybrid. It's a transition between the strong trend phase, the spike phase, the breakout phase, and the trading range phase. Most bull channels should be thought of as bear flags, because most bull channels, channels that go up and to the right, break out to the downside, and they function exactly the same as bear flags. So whenever you see a rising channel, you should always be thinking of it as a bear flag, even if it's part of a strong trend. You have to expect ultimately it'll break out to the downside. It may break out of the upside first, but ultimately you look for it to break through the downside. Bear channels, channels that go down and to the right, whether or not they're part of trends, you should always think of them as bull flags, because most of them ultimately break to the upside. So they're functionally identical to bull flags. Okay, here's a strong bull trend, and the channel itself is fairly strong, fairly tight. Pullbacks are not very big, but it's a channel, and it's a rising channel, a bull channel. Functionally, it's the same as a bear flag, so you have to be looking for a downside breakout, and that's what's occurring as we go sideways. So even the strongest type of a channel is functionally the same as a bear flag, and you should look for a downside breakout. This is that same strong bull trend with the bars compressed so that you can see what took place afterwards. So even a strong bull trend like this, if you have a strong steep channel, you should assume it'll function like a bear flag. It went sideways to break out below the bottom of the bear flag. Ultimately it broke to the downside, and then the trend started to resume. Channels usually are followed by trading ranges, and when you look at it after the trading range has formed, you say, it was actually part of the trading range. So here we have a trading range all the way across the screen, and the trading range began somewhere over here. Even though as the market was going up at this point, it was part of a bull trend, it was in a channel, and the channel ultimately usually becomes part of a trading range. Bear channels, same thing. Pretty strong bear trend, but a bear channel, so you should assume it'll break to the upside and function like a bull flag. And here we had a very strong upside breakout. And ultimately, a channel is usually followed by a trading range. If I remove these lines from the chart, you would look at this entire area as a trading range. So the channel evolved into a trading range. This channel, at this point, it's part of a bear trend, but at this point, you look at this channel and you say it's part of the trading range. As part of the market cycle, trends evolve into trading ranges evolve into trends. Within trends, the market starts as a spike or a breakout. Once it starts to develop pullbacks, there's some two-sided trading taking place, and it enters a channel phase. So let me talk about a bull channel transitioning into a trading range. Early on in the bulls are holding for swings. They expect the market to go much further. Early on in a channel, the bulls still expect the market to go much further. And they also trade primarily for swings, holding for a big move. As the channel goes on, after 10, 20, 30 bars, the bulls start to become concerned that there may not be much left to the trend, and they start taking profits sooner. So they start buying and then scalping out, causing small pullbacks. Buying, every time it goes up, they sell. And all of a sudden you start to get more and more bars with tails on the top and more sideways price action. Bears start to see that there's maybe a potential for profit if they sell. and initially they start to sell for scalps. And so they sell for a little push down. They buy back for a profit. And the bulls also, after they scalp out, they put their scalp back on the sell-off. And the result is another push up. Eventually you get some kind of topping formation, like a major trend reversal. And then the bulls stop buying on the pullbacks, and the bears stop taking profits. They hold for swings, and you can get a trend reversal. But initially, the bulls change from swinging to scalping, and that's usually the beginning of the transition from a bull trend, a bull channel, into a trading range. So here's an example. There's a bull spike and then a channel. There were spikes within the channel here and here. At some point, the bulls become uncertain that there's much left in the trend, and they start taking profits. So instead of holding for a swing here or here, they're selling out at the new high, and you're getting a reversal down. Once the bears start to see the bulls taking profits, the bears are more willing to sell for scalps. At some point, the bears are willing to hold more of their position for a swing, and they did get a small bull breakout here. So initially the bulls are swinging during the trend phase, the strong trend phase, the breakout phase. As the channel goes on, more and more bulls become less willing to swing, and they begin to take profits on their earlier positions, and their new positions they tend to treat as scalps, and they take profits more, and that results in deeper pullbacks and a broader swing and a more sideways market. And the bears begin to scale in, so they might sell here and sell more higher, and the bears become stronger, the bulls become weaker, and the result is a trading range. And the opposite is true with a bear channel transitioning into a trading range. A bear channel is part of a bear trend. The bear trend begins with a bear spike, and then it begins to have pullbacks and enters a channel phase. After a certain amount of time, maybe 10, 20, 30, 40 bars, the bears become less confident that there is much left profit to be made by going short, so they begin to take profits on their swings, and any new position that they take tends to be more of a scalp. So every time the market goes down, bears begin to buy. They buy back their swings and they buy back their scalps, and that creates tails on the bottoms of the bars, and the market starts to go more sideways. When the bulls see the profit taking by the bears, they begin to see the potential to make a profit buying for scalps. Every new dip, every new low, they buy for a scalp up. At some point, if there is a reversal pattern, maybe a final flag or a major trend reversal, the bulls will hold more and more of their position for a swing, and the bears will stop looking to sell again on the next rally. So here's an example. We have a bear trend. Within it there were spikes. There was a small spike here, and then a channel, and then a bigger spike, another spike, and a weaker channel. You could argue a bear leg here with a trend line break and a lower low major trend reversal, or a wedge bottom. In any case, we had a very strong bear here, and we started to channel down here, and you can see tails on the bottoms of the bars, strong reversal bar here, another one here. So that means the bears are beginning to take profits at new lows. So the bears who sold up here, the swing bears, they're taking profits. The bears who sold in here, they're taking scalping profits. So more and more profit taking by the bears, and the bulls are seeing these rallies, and they're deciding that, if I buy, I can make at least a scalp. When they see the wedge bottom, the major trend reversal, they think, well, maybe I can even buy for a swing. So the bulls are more willing to hold and add on to the position as the market goes up, and the bears stop selling. They think the bulls have taken over the market, and they're right, and we get the breakout. Ultimately, we had another higher low major trend reversal, and the channel evolved into a large trading range. But the major trend reversal, the bottom, resulted in a move up, and another move up large enough for bulls to make a swing profit. Rarely you'll have a bull channel going up to the right that has an upside breakout that is successful and has a lot of follow-through, and it will run far enough up for a profit if you're buying. Rarely you'll have a bear channel that will have a downside breakout, and the bear trend will accelerate, and the breakout will be strong enough to allow traders to make a profit by taking shorts. Here's an example. This is the monthly spider chart, basically the monthly S&P 500. We had a strong bull trend, and it evolved into a channel, and instead of the channel breaking to the downside and forming a trading range, we had an upside breakout with a follow-through for about a year. So we had a successful upside breakout of a bull channel, and the trend became a stronger trend, a steeper trend. With trend, breakouts of channels usually fail within about 5 bars. So if you have a channel running up and to the right, and then it breaks to the upside, usually the upside breakout fails within a few bars, maybe 5 bars, and the market reverses back down into the channel and goes all the way down to the opposite side of the channel. A with trend breakout of a channel, usually the start of the evolution into a trading range. The upside breakout of a bull channel usually fails, and then the market reverses down. A downside breakout of a bear channel usually reverses up, and then up into the and sideways, and the channel becomes part of a trading range. The upside breakout turning down or the downside breakout turning up, both are failed attempts to accelerate the trend. And if you see a reasonable signal bar on the reversal, you can usually get a reliable reversal trade that will carry down to the opposite side of the channel. Here's an example. We have a bull channel. The market tried to break out of the top of the channel, but we got a tail. Remember, a tail is a failed breakout attempt, so the market's reversing back into the channel. Not much room for a short here, but the market did make it to the bottom side of the channel by going sideways. The minimum target when you have a failed upside breakout is 1 tick below the bottom of the channel, which we achieved right there. The market then usually transitions into a trading range, which it's done right here. Here's another example. We have a bear trend channel line, and the market broke below the bottom of the line, a tail, so failed breakout. We have a bull inside bar here, possible buy setup, actually a possible higher low major trend reversal here, and we ultimately went up and tested the top of the channel. The minimum target is 1 tick above the top of the channel. Sometimes you get a very strong breakout like this, and it can result in a new trend. This trend line at first didn't look like it would contain the price action. The trend channel line was clear. The trend line, the top of the channel, was not clear, but this was the only logical choice for traders, and it turned out to be the actual top of the channel. The market rallied up to it and broke out to the upside. Remember, a bear channel is usually a bull flag, and it usually has an upside breakout. Here the lines obviously are not parallel. Very often lines are not parallel. Okay, again, as soon as you see one of the two lines, here the line below was the obvious one. As soon as you see one of the two lines, assume that the market is in a channel and that there's a way to draw a line on the other side that will probably contain the price action. And this was the most logical location to anchor the upper line. Channels can be very small, even a couple bars. They can be very large and contain all of the bars on the chart. They can also be very broad, with big swings in between, lots of bars going up and down, similar to a trading range, or they can be very tight, very steep, very vertical, very similar to a breakout. Channels can be horizontal. Trading ranges are channels. Remember, any part of the chart that can be contained within two lines, whether or not the lines are parallel, is in a channel. They can be diagonal. A lot of trends are all trends are up or down, so they run diagonally. Wedges also run diagonally. The lines can be divergent, as with an expanding triangle, and they can be contracting, as with a triangle and a wedge. A wedge is a type of triangle where it's either sloped down or sloped up. The market's always in many channels, whether or not you see them. Many of the channels can only be seen by looking at other time frames. A bull channel on one time frame may be part of a bear channel on another time frame. Every trend is either in a spike phase, a breakout phase, or a channel phase. The spike, breakout, very one-sided trading, no pullbacks, and then that is replaced by the channel phase, where two-sided trading increases and there are pullbacks. Less often, there's just a little overlap of the bars without actual pullbacks. A micro channel, I'll talk about that in another module. What's the minimum requirement for a pullback? In a bull trend, if the low of the current bar is below the low of the prior bar, the current bar is a pullback. It may be a one-bar pullback, or it may be the start of a big pullback lasting many bars. In a bear trend, when the market's going down, if the high of the current bar goes above the high of the prior bar, the market has a pullback. For spikes and breakouts, you should take a look at the modules on breakouts. Remember, spike and breakout are two identical terms. They're interchangeable terms. They mean the same thing, a very strong trend. A spike. Every trend bar is a spike and a small trend. Most of the time, the market ends up going sideways and it becomes part of a trading range. However, it can lead to a trend if the spike is strong and if the context makes sense. Is it logical to expect a trend right now? Channel. As soon as the breakout begins to have a pullback, let's say you have a bull breakout, as soon as it starts to have a pullback, that's evidence of two-sided trading, and it's evidence that the spike phase is probably ending and the channel phase is beginning. And then the channel runs its course and evolves into a trading range. A pullback, it can be as small as a single bar, like in a very strong trend, or it can also contain many bars. And if it contains a lot of bars, the trend is weaker, and it may in fact be the start of a trading range. Once you have a pullback, you could start to form a channel or a trading range, or you could get another spike. So you can have a spike up and then a pullback and then another spike up, or you can have a spike up and a pullback and then a series of stair steps up in a channel. What's the minimum requirement for a bull channel? A series of higher highs and lows. The minimum requirement for a bear channel? A series of lower highs and lower lows. Channels, as I mentioned, are sometimes hard to spot, and beginners sometimes have a hard time seeing channels, especially when the channel lines are not obvious and not parallel. But you got to remember, the market's always in a channel, and as soon as you see either a trend line or a trend channel line, a line above the market or below the market, there is a channel, even if you don't see the opposite side. Again, channels can be very vertical and very tight, almost as strong as a spike, and they behave basically like a spike. They can also be very broad, having big swings, and fairly horizontal and behave more like a trading range. Both are types of trends, but a channel, whether it's vertical and tight or weak, is still a weak trend compared to the spike phase, the breakout phase. Okay, it's still, any channel is still a weak trend, weak compared to the breakout phase. It can be very steep and very tight with the lines close together and the pullbacks very small, and it can behave much more like a spike, a breakout, and when that's the case, it's almost always a spike on a higher time frame chart. And when you have a channel that is as strong as that, you should only take trades in the direction of the trend. even though there's some two-sided trading taking place. Channels can also have lots of swings and be very weak, and like a wedge or a stair pattern. The lines can be far apart. The channel can be almost horizontal, and when that's the case, it's behaving much more like a trading range, and you should trade it like a trading range. Trade in both directions. When the channel is tight and strong and the pullbacks are very small, the market is extremely one-sided. The extreme example of a very tight channel, a micro channel, where there's a series of bars that overlap, for example in a bull micro channel, but none of the bars falls below the low of the prior bar. So that's a very strong channel. It's still a channel, but it's not quite as strong as a breakout. A tight channel is the strongest type of channel. It's much more similar to a breakout than a trading range. Again, it's a spike or a breakout on a higher time frame chart, and you should only trade in the direction of the trend when you see an extremely strong channel. For example, a tight bull channel. The pullbacks are very small. There's very little selling going on. The bears are in control only briefly and only intermittently. However, there's enough two-sided trading to qualify as a channel instead of a spike. A spike, there's virtually no pullback. A bull spike just goes straight up. A channel might go up and have a one-bar pullback, and then up again, another one-bar pullback. Here's examples of tight bull channels. It's not a spike phase because we got a lot of small one-bar pullbacks. A doji bar here, a bear bar here, a couple of bear bars here. So it's not quite a spike phase. On a higher time frame chart, it would be a single bull trend bar or 2 or 3 bull trend bars on a 15-minute or 60-minute chart. Actually, this is a weekly chart. So on a monthly chart, this is probably a 1 or 2 or 3 very strong bull trend bars breaking out. Here again, strong channels, tight channels, but a slight pullback here, the low below the prior bar. Here there are no pullbacks, so these are micro channels, 11 bars without a pullback, here 12 bars without a pullback. So it's a tight channel, but I call that a micro channel when there are no pullbacks. Here a tight channel, but there are pullbacks, so it's not quite as strong. This is an extremely common situation when you're looking at a chart and you see a pretty good bull spike here, markets making higher lows and higher highs. Is it going to be a strong bull channel or a weak bull channel? If it's weak and has broad swings, you can trade it in both directions. If it's strong and the pullbacks are very small, you should only look to buy. It doesn't matter. Whenever you look at it and you're not sure if it's weak enough to allow for trades in both directions, only take the buys. When in doubt, only look to buy. Remember, a bull channel is a bull trend, and if you're wondering if it's weak enough to allow for successful shorts, if you have to think about it, don't take the shorts, only take the buys. Up here, we started to evolve into a possible trading range, and we have a strong signal bar. So here I would consider scalping a short. Bull channels can be strong or weak. A strong channel, there's minimal two-sided trading and it behaves more like a breakout, and you should only trade in the direction of the trend, buy. A weak channel, prominent two-sided trading, and it behaves more like a trading range that's tilted up, and you can trade it like a trading range. Buy low, sell high, and scalp. When you're having a hard time deciding whether a channel is strong or weak, assume that it's strong and only look to buy when we're talking about bull channels. Here's an example of a pretty strong bull channel. Pullbacks are very small. You're not going to make any money on the shorts. You should only look to buy. Here, on the other hand, a daily spider chart, big swings, forming higher lows, higher highs, so we're in a bull trend and we're in a broad channel, but the swings are so big and the channel is so flat, it's much more like a trading range that is slightly tilted up, and you can take trades in both directions. You can buy and you can sell at the top. Weak bull channel. Bull implies trend. Channel implies a weaker version of the trend, weak compared to the spike phase of the trend. The weaker the channel is, the more likely you can trade in both directions. Weak channels, broad swings, very two-sided. If it's a very tight channel or reasonably tight, only trade in the direction of the trend. What constitutes a weak channel? A broad bull channel. You have overlapping bars. You have weak follow-through, so you'll have a bull bar and then maybe a small bear bar or a doji bar. Many bars with tails on the top, so selling into the close of the bar. Many bars in the channel with bare bodies. You'll have obvious pullbacks where a bar has a low below the low of the prior bar. You may have 2 or 3 in a row, or a pullback that goes down 4 or 5 bars, and you can have big swings up and down. And it looks more like a trading range that is tilted up. Here's an example of a broad bull channel in crude oil, higher highs and higher lows. You can trade that in both directions. A bear channel can be strong or it can be weak. When it's strong, there's minimal two-sided trading, and it behaves much more like a bear breakout, a bear spike, and you should only look to trade in the direction of the trend. You should sell. A weaker channel has more prominent two-sided trading, and it behaves more like a trading range that's tilted down, and you should trade it like a trading range. Buy low, sell high, and scalp. When the channel looks very vertical and very steep with very small pullbacks, it's two-sided. We have some sideways motion, some upward motion, but not enough to make a profitable long trade. So when it looks like this, only trade in the direction of the trend, only sell. On the other hand, when it looks like this, we're forming lower highs and lower lows, so it's a bear trend. It's obviously not a bear spike, so it's a bear channel. You can take trades in both directions. Sell near the top, buy near the bottom. When you can't decide if a channel is strong or weak, a bear channel, assume that it's a strong bear channel, trade it like a strong bear channel, and only look to sell. A very tight bear channel, very small pullbacks, very one-sided, very vertical. There's very little buying. The bulls are in control only briefly and intermittently, only long enough to fulfill the definition of a channel in contrast to a spike or a breakout. Here's an example. You got a very strong spike here. This is a spike, but it's also pretty much of a channel down here. You could argue that the whole move down is a channel. But it's very, very strong. I would not be looking to buy when the market looks like that. Again, a spike and then a channel. This channel is a very tight channel. I would not be looking to buy when the channel looks like this. This is a daily chart of crude oil. Within this channel, there's a spike and then a smaller channel. So you very often get nested patterns where there's a pattern within a larger pattern. This is that same slide with lines drawn in. Remember, anytime you can draw lines above and below the price action, it's in a channel. So this is a channel. It's very tight. The same over here, very tight channel. A weak bear channel. Bear implies trend. Channel implies a weak trend in contrast to a spike or a breakout. Again, the weaker it is, the more likely you can take trades in both directions. A weak channel has very strong, very broad swings, very two-sided market. If the channel instead is reasonably strong and very tight, very small pullbacks, only trade in the direction of the trend. In the case of a bear channel, only look to sell. What constitutes a weak bear channel? You have a lot of overlapping bars, weak follow through after a bear trend bar. So you'll have a bear trend bar and then maybe a bull bar, a bear trend bar and 2 bull bars. You'll have many bars with tails on the bottom, buying into the close of the bars. You'll have many bars with bull bodies. You'll have obvious pullbacks, often with very big swings. And it looks more like a trading range that is tilted down. Here's an example of a broad bear channel, the weekly euro versus the dollar Forex. You can see strong bull bars up over here again, but consistently getting lower lows and lower highs. Sometimes you just can't tell whether the market's in a broad bear channel or in a trading range. And most weak channels, most broad channels begin as trading ranges. So very often the market is both within a trading range and in a channel. And the market's transitioning from the trading range into the channel. Once the market clearly begins to form higher highs and lows, then a bull channel is forming, a bull trend, and the market is leaving the trading range phase and entering a trend phase. If instead the market starts to form lower highs and lower lows within the trading range, the market is entering a bear channel, a bear trend, and it's leaving the trading range phase and entering a trend phase. For example, you look at this chart and you think, well, clearly a trading range. But what else do you notice about this? Okay, look at this high, and this high. We're getting lower highs. Look at this low and this low. We're getting lower lows. You can argue that we're getting higher highs over here, and we were, and higher lows. So you can argue that it's a bull trend. From this point onward, we're in a bear phase, possibly a bear channel. So, yes, it's a trading range, but it may also be the start of a bear channel, a bear trend. And this is what followed. We had a strong bear breakout from the trading range. We got another lower low, and then the trend accelerated into a strong parabolic channel into the end of the day. So we had a trading range, and it started forming lower highs and lower lows. It had a bear breakout, and it became a bear channel, a broad bear channel, and eventually it became a parabolic, very tight bear channel after this strong bear breakout. Okay, so what do you see here? Clearly a trading range, but we have a low, a higher low, maybe another higher low. We have a high, a higher high, another higher high. So it might be evolving into a bull channel. So it's clearly a trading range, but it's also possibly part of a bull channel. We got a bull breakout here, and we have follow through. We have a breakout bar, and the next bar has a bull body. So we have a trading range and the start of a bull channel, and now we're actually breaking out. And instead of a bull channel, this may end up as a bull breakout, a strong bull trend. And this is what followed. We did get a very strong breakout. So instead of this continuing up as a channel, it broke out into a strong bull trend, and it became a spike and not a channel. Weak channel or trading range. When you have weak channels that are mostly sideways and broad swings, they're usually also trading ranges. And it doesn't matter whether you call it a trading range or a weak channel. You treat them the same. You trade them the same. You look to buy low, you sell high, and you scalp. Here's an example. The entire screen is in a trading range, but you can also see that it's in a channel as well, forming a series of lower highs and lower lows. It doesn't matter whether you call it a weak bear channel or a trading range. You're going to trade it the same. You're going to buy low and sell high and scalp. So you're buying near the bottom and you're selling near the top and you're scalping. Here are some examples of other channels. Anytime you can draw two lines, you have a channel. Here the two lines are convergent. They're getting closer together, and it's a rising wedge. Here we have parallel lines. This is the most conventional type of channel that people consider. Here we have two lines, and they're getting closer together. They're convergent lines, and it's a triangle. All are types of channels. Here we have two lines containing the price action, and the lines are getting further apart. And this is an expanding triangle. In this case, we have a bear trend, an expanding triangle bottom, and a rally. I'll talk about this in a later module, but expanding triangles are always lower low expanding triangle bottoms are always lower low, major trend reversals, and strong buy signals. The market always has channels within channels and channels within opposite directions. We have a large bull channel, bull trend, and within it we have a pullback. And a pullback is a bear trend, and in this case the bear trend is in the form of a channel. Within that bear trend there is a rally, and that rally was contained within a channel. So within the bear trend there's a bull trend, and both are within a larger bull trend. So the market is usually within many channels all at the same time. How to draw channels? Let's look at the red line first. We can, as soon as you see 2 points, you can draw a line. So you can draw this line, and then if you want, you can create a parallel and drag it upward to a swing high that contains all the prices between the two original points. And that would be a trend channel line, and you look for an upside breakout and a reversal down to short. You can also, well, let's look at the blue lines. You can also use swing highs above the channel and connect them to create the top of the channel. So here's a high, here's a swing high. So you can connect the two with a line, and that also creates a channel. It doesn't really matter which you do. You use whatever looks like it's working. Whenever the price gets near either line, you see how it behaves. And if you see a reasonably good sell setup near the top, then you go ahead and you short. Again, the red lines are using highs and lows. So connecting highs up here, connecting lows over here, and then down here we have a new low, so you draw a new channel. The blue lines are parallels. You draw this trend channel line above, you create a parallel, and you drag it down here to a prior swing low, and that tells you to look in this area to see how the market behaves when it gets there. Red lines again are just drawn based on highs and lows. Blue line, it's a parallel from a red line. So here we drew a trend, a bear trend line across these two highs, created a parallel and dragged it down below, and you can see the market poked a little bit below it and reversed up. So you're looking for reversals on failed attempts to break out of the top or the bottom of the channel. Every breakout below a bull channel allows you to draw a new line. So we had this blue line here. The market broke below it and turned up. So you draw another line using this low. And what do you see about these two lines? The second line is flatter. The market broke below it, so you draw another line. It broke below it, you draw another line. Broke below it, you draw another line using the new low once the market turns up. And what do you notice about all of these blue lines? They're getting flatter and flatter, and the channel is getting broader and broader. That's the natural evolution of a channel. It tends to get breakouts, and each new line that you draw tends to be flatter, and eventually the channel gets broader, and it eventually evolves into a trading range. At some point, you can start drawing channels in the opposite direction, and the bears take control over the market. Sometimes you'll have several possibilities for the lower lines. So let's say you drew a trend channel line across these tops, or even this blue line here, and you're wondering where the bottom of the channel is. If the market's reversing down, you're expecting it to hit the bottom of the channel, but you have a whole bunch of possible bottoms of the channel. Okay, so your first bottom of the channel is here. It broke through it. It rallied a little bit, and it turned down again. You have another possible trend line here as a parallel of this line. It broke through that. So then you start looking for other possible bottoms to the channel. You take this line, create a parallel, drag it down to a swing low. That's a possible bottom to the channel. The market broke through it, did not turn up very well. It turned down again. So you take a parallel of this line and look for another swing low and drag the line down here, and maybe this will be the bottom of the channel, and maybe that will contain the price action. And ultimately, that's what happened. This is the market crashes in 87 and 2008 and 2009. Here's the inset for the 87 crash. Okay, look where the crash ended, exactly at a monthly trend line, right? So you have to think that there might be a channel there. However, anytime the market is making violent big moves, it's usually going to end at some kind of a trend line or trend channel line. Here's the 2008-2009 crash. And if you use the low of the 87 crash and then this low here and draw a trend line below, the 2008-2009 crash poked a little bit below it and reversed violently up. Now look at over here. There's one other obvious line from this swing low to the 87 crash low, and we did not reach that line. So that ultimately may end up being a magnet that pulls the market down to this level. At the moment it does not seem likely, but you have to keep that in mind, that we have important lows, the 87 crash low, so it can create important trend lines, and the market may have to come down and test that lower line. Why are channels difficult to trade? Because uncertainty is high, and the reward sometimes can be low compared to the risk, and the channels are always trying to reverse. Sometimes the trend accelerates and has a breakout in the wrong direction, so you can have a bull channel and then a bull breakout, or a bear channel and a bear breakout, and it can accelerate into a stronger trend. I think this chart is interesting of Apple. You have a trend line along the bottom. You can create a parallel and you get this blue line, and we accelerated through the top of the channel into a stronger trend. However, when you draw another parallel and you anchor it to back here in 2007, the market touched that line exactly and then pulled back. Currently the market is up here above the top of that channel. However, I think there's a pretty good chance that we're putting in the top for the next year or two, and that will work down to the bottom of the channel in Apple. The channel's rising, so by the time Apple gets there, it might be at 550, 600, but I think Apple's putting in a top up here, or at least the end of the bull run and the conversion into a trading range. This is a shrinking stairs pattern. I talk a little bit more about this in the module about trading. I'm just mentioning it here. We have a channel. I don't have the lines drawn in, but look what takes place. This pink box is this low, the breakout point. The market fell below it to the low of the next breakout point, and then we broke down to here. This box is the height of that breakout. This box is the height of the breakout below this low and the next swing low. And you can see how the breakouts are getting smaller and smaller. So the bears are losing momentum, and there are trades you can make based upon the shrinking of the stairs. You can fade the breakouts, and I talk about that in one of the later sections on trading bear channels. Here you can have a weak bull channel and a bear, right? You have a bear trend, and this channel looks very weak. It's not a strong bull trend. But look what followed. We ended up with a pretty decent bull trend. Look at what's going on here. We're falling below the lows of the prior bar, and then we're getting a big tail. We fell below the low of this bar and a big tail. We fell below the low of this bar and a big tail. And a big tail here. Fell below this bar, big tail. Fell below this bar, big tail. Remember, I talked about buying pressure, and it can be an early sign that the bulls are taking control over the market. And that's what all of these tails are telling us, that we're starting to accumulate a lot of buying pressure, and the bulls are buying below the low of the prior bar. So instead of looking at this as a bear flag and shorting on a stop below, traders are saying, oh, look at all these tails. We got several good bull bars. We had a bull bar here. We had a bull bar here. Maybe we're going to rally. So traders, instead of selling at the lows of the prior bars, are placing limit orders to buy at the lows of the prior bars, betting that we're in the process of channeling up. That is the end of the module on channels.